Ladies and gentlemen, welcome to Politically Correct Ghana lesson 361. And today, the 10th of May, 2026, we want to discuss credit crunch amidst low inflation rate in Ghana. As of now, the 10th of May, 2026, we are aware that the April inflation rate is 3.4%. It has upped a bit, but that's normal. The good thing is that the government has done very well. The government of John Dramani Mahama and NDC have done very well to have brought inflation rate so low, heading for deflation, which is very good. The Bank of Ghana Governor, Dr. John Mahama, has done very well. And then the Finance Minister, they've done very well. We are looking at a situation where inflation rates and interest rates are moving together. They move parallel. But in the case of Ghana, the situation seems to be different, where the inflation rate is standing at 3.4% as of April 2026, and then the lending rate is as high as 28%. And that is what is causing the credit crunch, because with such variations, the difference between the lending rate and the inflation rate is the real interest rate. That is, if you take the lending rate of 28% and you subtract the inflation rate of 3.4, you are talking about 24% thereabouts. That is a real interest rate, and that is too high. That's almost a quarter. That if you borrow, almost a quarter of your income would have to go into repayment. And so there is credit crunch. Businesses are not borrowing to invest. So you find the whole economy slow down. That's one. Businesses are not borrowing to invest. Businesses are not borrowing to expand. They are not hiring more people. So unemployment is still high. You follow the point. Then, of course, individuals are not borrowing to spend, making the velocity of money slow. And once the velocity of money is slow, the money in circulation is slow, and what we call V1, V2 slows down, then there's a problem. There is a problem in the economy. It has to be moving very fast. So then, Bank of Ghana Governor, please, Dr. Siama, it's up to you. Let's look at it very well. Why I said there's a credit crunch. Look at the loan rate or the lending rate in Ghana. The formula is known as what? The reference rate plus the bank's what? Margin. The bank's margin cannot be more than the inflation rate. The bank's margin cannot be more than the inflation rate. So if the reference rate is 10% plus the inflation rate, which is 3.4, then you're talking of 13.54%. So technically, no bank should be lending more than 15% at a rate of 15%. No bank should be lending to customers at a rate higher than 15%. If you hold on to that formula, then you can take another formula. What will be the lending rate if you look at another formula? If they're going through the Bank of Ghana monetary policy rate is 15% plus the bank's margin of 3.4%. So you're talking of about 18.4% should be the lending rate. So that could be the cap. The minimum can come as low as what? 13.4%, and the cap could be as high as 15.4%, or 18.4%. So the lending rate should range between 15%, 15.4%, and of course 18.4% as of today, May 2025. However, that's not the case. You go to the bank and you find the lending rate are as high as 28%. It means that there's a problem. The governor of Bank of Ghana call all the commercial banks or the universal banks or all other lenders. Have a chat with them in a conference room and ask them what their problem is, and that they should just go by this formula. Let them go by the formula so that the lending rate drops and the credit crunch would cease and businesses will flow. They'll borrow to expand, borrow to set up new businesses. They'll hire more people. And then the system will revolve. The more people they hire, once they pay them, they get their salary, they'll be spending. Once they spend, the cedi keeps moving faster because a little will be left for savings. Mind you, there's one key that you have forgotten. That's the what? Treasury bill rate. The treasury bill rate is about 5% for 91 days. It's low. So people are not going to be saving. The name is H. Kwame Afaglo.